Welcome everyone back to the Noob Selling Options channel. Let's jump right into today's explainer, where we're unpacking a massive, honestly mind-blowing 250% market rally in SanDisk. The big question we are looking at is this: is this a generational AI play, or is it a cyclical trap just waiting to spring? I mean, we're talking about a stock that recently smashed right through that $1,000 mark. It's on an absolute tear. So today we're going to break down exactly what's fueling this rocket ship, and more importantly, what the underlying math and history tell us about where it's heading next.
So look, everyone sees the ticker crossing $1,000, right? But the real issue is the greed blinding us to the cyclical reality here? It's incredibly easy to get caught up in the hype when a stock goes completely parabolic, especially when it's attached to the whole AI boom. But to figure out what's really going on, we have to strip away all that emotion. We need to look at the hard data from the momentum chasers and weigh it against the warnings from seasoned value investors.
Here is our roadmap for today. First, we'll cover the SanDisk AI boom. Second, we'll look at Peter Lynch's stark warning. Third, we'll dive into the CapEx death spiral. And finally, we're going to map out the Fibonacci tops.
Section 1. The SanDisk AI boom. Let's look at why SNDK is up over 250% in 2026.
Okay, $1,400. This massive price target from Cantor Fitzgerald really highlights the absolute frenzy pouring in from Wall Street right now. When you start seeing numbers like this thrown around for a hardware manufacturer, you know the market thinks a fundamental shift has happened. Analysts are aggressively hiking their targets, basically pouring gasoline on the fire and convincing everyone that the sky is literally the limit.
And honestly, we're looking at the perfect storm of bullish momentum here. AI infrastructure takes an unbelievable amount of data storage. So right now, there's a severe supply crunch for high-margin enterprise SSDs. Data centers are snatching up literally everything SanDisk can produce. Add to that Melise Research tossing out a $1,350 price target, plus the fact that SanDisk's April 20th inclusion in the NASDAQ 100 forced mutual funds to automatically buy the stock. It is a total recipe for a parabolic move. Plus, with management guiding for massive 65 to 67% margins for Q3, investors are just piling in early.
Section 2. Peter Lynch's stark warning and why the legendary investor would be selling SNDK right now. Be fearful when others are greedy. That famous quote really hits the nail on the head here. The core of Peter Lynch's perspective warns us not to mistake a temporary commodity boom for some permanent new normal. Right now, the market sees SanDisk's skyrocketing revenue and just assumes that the AI data center buildout has somehow magically cured the cyclical nature of the memory market. But history tells us that when greed is this high, you absolutely have to step back and look at the actual business mechanics.
And this brings us to a super counterintuitive rule known as the low PE trap. See, SanDisk actually looks dirt cheap, trading at just 7 to 9 times forward 2027 earnings. But here's the catch. For hardware cyclicals, a low forward PE signals the absolute peak of the party before the inevitable 2028 drop. Lynch loved buying cyclicals when earnings were terrible and the PE looked crazy high, and he'd sell them when earnings hit record highs and the PE looked cheap. Right now, SanDisk is sitting right in the middle of that exact trap.
People are basically pricing SanDisk like it's a software monopoly, a true AI fortress. But unlike those mega caps with sticky, recurring cloud revenue, SanDisk sells a hardware commodity. Sure, when supply is tight, they have absolute pricing power. But, and this is absolutely crucial, hardware cycles always break. Valuing a commodity seller with the same premium as a recurring software fortress is exactly how investors end up caught holding the bag.
Section 3. The CapEx death spiral and the reality of hardware commodity cycles.
It goes like this. Greed breeds oversupply. Memory makers hit these record 67% margins, right? Then, billions get funneled into building shiny new fabrication plants. Competitors do the exact same thing. Fast forward 12 to 24 months, AI demand starts to normalize, just as all that massive new supply hits the market simultaneously. And boom, prices don't just dip, they crash. That is the heartbeat of the hardware cycle.
Think about the numbers here. Lynch would have bought back during the past glut at those abysmal 26% margins. But today, with projected EPS growth of 1,300% and margins peaking around 67%, the easy money has already been made, guys. Those incredible margins can revert back to 25% practically overnight once that glut hits. Lynch wanted in before the institutions piled on, back when nobody cared. Now with forced index buying and massive Wall Street upgrades, the stock is basically fully priced.
Section 4. Mapping the Fibonacci tops to identify possible topping zones above $1,000.
Because SanDisk has gone totally parabolic, traditional resistance lines above $1,000 simply vanish. There's no historical chart to tell us where the sellers are hiding. So institutional quants and algorithmic systems rely on mathematical sequences called Fibonacci extensions to map out potential tops and take profit zones based on the base of this year's massive 250% rally.
What's really fascinating here is how the 1.618 extension, the golden ratio sitting around 1350 to 1380, perfectly overlaps with Wall Street's price targets. This creates a massive wall of selling pressure. At the 1.272 level, around $1,180, you hit your first major friction point where momentum traders will start taking quick gains. But that golden ratio overlap is the critical cyclical top target. When algorithmic math perfectly aligns with Wall Street fundamentals, the supply of stock flooding the market from profit takers is going to be immense. As for the 2.618 level at $1,650, well, that would require absolute peak, wild euphoria, and a crazy short squeeze before a completely violent reversion.
Look, because this stock is priced for absolute perfection right now around $1,070 with literally zero room for error, I definitely will not buy now. I will look to adjust my strangle, put, and call tonight when the market opens. Because think about it, if SanDisk minces earnings this Thursday by even a fraction of a cent, or if management even hints that future order velocity is slowing down, the multiple compression is going to be absolutely brutal.
So I'll leave you with this question to chew on. Will you ride the algorithmic momentum and risk a brutal multiple compression, or stay disciplined, sit back, and let others be greedy? The math, the history, and the commodity cycles are all laid out right here for us. Please don't forget to like and subscribe if you found this explainer helpful. Thanks for watching, and I'll see you all in the next one.